Here's a quick tour of Bangladesh's share market, how it began, why it matters, and what the numbers whisper about the future. If you think stock markets are only about skyscrapers and Wall Street, hear me out. Bangladesh's market has crashed, rebounded, and quietly funded one of the fastest growing economies in Asia. In 3 minutes, I'll give you the arc, the history, the growth story, and the stats that actually matter. First, the origin story. The Dhaka Stock Exchange started life in 1954 as the East Pakistan Stock Exchange. Trading kicked off in the late 50s, went dark during the Liberation War, and reignited in 1976 as an independent Bangladesh looked for capital to rebuild. In the 90s, reforms arrived, dematerialized shares, a central depository, and a second bourse, the Chittagong Stock Exchange in 1995. But markets learn by burning. In 1996, a retail-driven bubble inflated and burst. Many lost savings. Regulations toughened. Growth resumed with the 2000s boom. Then another surge and correction in 2010-11. Surveillance improved, IPO processes tightened, margin lending was reined in, and the Dhaka exchange demutualized in 2013. In 2018, strategic partners from China's exchanges came in. So what's inside the market? Banks and financials, textiles and garments, the export engine, telecom, led by giants like Grameenphone, pharmaceuticals, power and energy, cement, consumer goods. It's still a retail-heavy market, but institutions, mutual funds and pension money are slowly growing. There's an SME board for smaller companies and a nascent corporate bond and sukuk scene, though the bond market is still thin. Now the bigger picture, Bangladesh's economy. Over 3 decades, the country shifted from aid to trade, garments, remittances, and a rising domestic consumer base. GDP has compounded at roughly 6 to 7% a year for much of the last 20 years. The Padma Bridge, expanding power capacity, and urbanization powered new demand. Per capita income climbed steadily, and a young workforce keeps feeding factories and services. Challenges? Absolutely. Inflation and currency pressures since 2022, a weaker taka, dollar shortages, and stress in parts of banking. Governance and transparency still need work, and the bond market's small size pushes too much financing onto banks and equities. Stats: 2 exchanges, Dhaka and Chittagong. Market cap: tens of billions of US dollars, small relative to GDP. Sector tilt: financials, telecom, textiles, pharma, and power. Investors: retail dominates daily turnover. Institutional participation is growing but remains modest. Key reforms: demutualization, 2013. Better surveillance, centralized depository, tighter margin rules, an SME board, and initial steps toward a functioning bond sukuk market. Risk markers: past bubbles, 1996, 2010-11. Liquidity swings, corporate governance gaps, and FX and inflation shocks. Why it matters? If Bangladesh keeps compounding growth, deepens its bond market, and raises transparency, equities can become a real engine for funding factories, power plants, tech, and consumer brands. More listings from strong private firms, better disclosure, and long-term pension money could transform a retail-driven market into an institutional one. My take: I see a market that's small, volatile, but leveraged to a big demographic and export story. Not a meme roller coaster, an emerging market marathon. History shows the risks, the growth shows the prize, and the stats show how to get there. Better governance, deeper bonds, more quality IPOs, patient capital. If you're watching Bangladesh, watch the basics: earnings, cash flows, governance, and policy. Thanks for listening.